it worries me to some extent. It tells me that you need to be more selective. I mean, if you look at, and we're talking about the rotation, continuing of the rotation, if you think about it now, growth stocks really, on average, are still twice the PE of value stocks. And that goes for the US market or any of the equity indices. So I think this does make investors a lot more nervous about some of those long duration sectors, such as tech and communication services and the US consumer discretionary. I think we've been seeing that in markets for weeks now.
The problem is, when we talk about the dot-com bubble bursting in 1999-2000, Rebecca, as you know as well as I do, every stock went down pretty much during that dot-com bubble burst. We all got tarred with the same high valuations in one sector. It could happen again, couldn't it?
I hear you. There are always going to be people who draw parallels like that, but I think we're in a market that is worrying about value. But if you pick that value right, there is still room for those particular areas of the market to work. If you think about it, ever since March the 23rd last year, we've been looking quite a long way forward, 9-12 months forward. There's no reason to suggest now that we're going to stop looking forward and we're going to stop looking for that recovery, that more mobile summer that we're all hoping for.
Yeah, I'd pick up on that as well, Rebecca. I mean, it does seem to me that as you put sentiment up against valuation, valuation is just not an issue at the moment, given how excited people seem to be about the potential for further upside. And I know that the II sentiment survey in the States, which is a sort of mum and pop investment survey, is now the most bullish it has been at any point so far this year here. So with all those green lights, where do you think the money is going to flow to here? Because as you were discussing with Karen, I think this question of whether it's cyclical vs growth is critical at this moment, it seems, for the near-term returns.
Well, I think if you think about year to date, well, really, actually, since November last year, so since we had the first positive vaccine announcement, two things have been happening. It's been cyclical over growth. It's been value over growth, cyclical over defensive. And I think that's very much the tone for the next couple of months. There were three things that were really driving this at the beginning. One was the gap in valuation. The second was the difference in holdings, because don't forget how underweight a lot of the real money, the big institutional investors had got in areas like energy. And the third thing, and I think this is possibly the most important driver now, is that earnings momentum, that earnings recovery. As much as we love tech, and who wouldn't want to hold tech for the next 10, 20 years, tech is not going to show that recovery of earnings for the next 2 years because it's done very well while we've been working at home. Whereas other areas, and I'd point you to something like materials or industrials, they really are going to see that pick up as we see us return to a more normal way of life and hopefully get those infrastructure bills working in Europe and hopefully here more in the US.
And can I ask you about some of the more exciting parts of the market that we've seen over the last few months here, namely what's going on around the SPACs? There was a bit of a focus yesterday on Arrival, this mobility SPAC in the UK, which I think left some feeling a little bit flat. Have we seen the SPACs have their run here? Is this a time perhaps just to walk away from this particular segment?
And we may well have do. I actually remember last time I was on with you, we talked about GameStop and the retail excitement over Reddit. You know, these things come to light, they excite the market for some time, but then really people start to go back to the fundamentals and what's driving the market. So this may just be another one of those things that's seen its day.